Hey everybody, Rob Maurer here, and today we are of course talking about Tesla's Q1 earnings report. Tesla has just released their shareholder letter with some information and all of the financials, and coming up shortly, Tesla will have its Q1 earnings call with investors. So while we wait for that to happen, I'm going to go through the shareholder letter on this episode, and then I'll do a second episode, so switching it up a little bit here for the earnings call. Both will be out today though, so keep an eye out for that. Alright, so obviously a strong release here from Tesla. After hours, the stock is up about 10%. to almost $880 after rising today by already about 4% during trading. So I want to go through how Tesla compared to my estimates and how they compared to street consensus estimates, but obviously ahead of expectations, hence the stock price rise after hours. So first, just want to congratulate Tesla on an amazing first quarter. There are actually a ton of different positives, and we're going to go through all of them in this release, but the headline is that Tesla posted a surprise GAAP profit of $16 million and a non-GAAP profit of $227 million. So looking at these results compared to street consensus and my estimates, if we look at that GAAP net income number of $16 million, I had forecast a loss of $246 million. So more than $250 million beat there from my estimates, and even more so from the $286 million loss expected from the company compiled estimates. So a huge beat there and a similar spread on the non-GAAP number. And there are two main factors that drove this. The first is something that I said I would have my eye on most closely with this release, and that is Tesla's automotive gross margin excluding regulatory credits. That came in at an actual of 20.0%. That is more than 3 full percentage points ahead of what Wall Street expected at 16.8%. I was even higher than that, and I said if Tesla can even achieve this or beat it, that's a strong positive, and I was at 18.5%. So as we talked about, my forecast had estimated a 10% gross margin on Model 3 from Gigafactory Shanghai and a relatively good margin of negative 20% on Model Y. I know good doesn't sound good if it's negative 20%, but for that early in the Model Y production process, negative 20% would have been good. This is where Tesla beat. Tesla says in their shareholder letter, quote, gross margin at Giga Shanghai approaching level of US made Model 3, end quote, Model Y gross margin positive in Q1. End quote. So obviously there are many ways that math can mix out, but one of the ways that I think is pretty close and works out in my model is to have Fremont Model 3 margin at 19%, Gigafactory Shanghai margin at 16%, and then Model Y margin at a positive 2.5%. Throwing those all in with a combined Model S and X margin of 20.5% gets us to Tesla's 20.0% overall. This is incredible. I cannot overemphasize the importance of these two statements from Tesla. This means that Tesla has proven in their financial results that not only can they ramp up vehicle production quickly, they can also do it extremely profitably. Oh, and by the way, they're able to do that on multiple continents. Tesla broke ground in China in January of 2019. January of 2019. Tesla went from breaking ground on a factory to producing in volume at a profitable level greater than 15% on, by the way, their lowest trim vehicle. This is the standard range plus Model 3. That's all they produced out of Gigafactory Shanghai in Q1. So they went from literally nothing to profitable volume production in 15 months. As if that weren't enough, Tesla then also started producing Model Y in the same quarter and then also was able to get that to gross margin profitability in the initial quarter of production. That is incredible. This is important for two reasons. For this year, in the short term, this will bring margin forecasts up. Tesla was way ahead of street consensus here. That's going to apply in future quarters too. They have to come up. And then longer term, and more importantly, Tesla has demonstrated, as I said, their ability to ramp quickly and ramp profitably. That means Tesla's going to have no trouble getting deals with certain locations. They're going to have no trouble getting capital, and their return on that invested capital is going to be very quick, allowing them to continue to grow at an extremely rapid pace. I mean, think about this. Shanghai in Q1 produced roughly 16,500 vehicles from reports in China. That's about 65,000 vehicles per year. Over time, Tesla could bring that production rate up by 10x. If Tesla's already at a pretty solid gross margin at 1/10 of their capacity, what are margins going to look like when production is a full order of magnitude higher? Spoiler alert, they're going to be awesome, and that means Tesla's got a very clear path to bring their average selling price and their retail price to consumers down and continue to grow volume. The path and the indication of Tesla becoming a mass volume manufacturer is right here. It's plain as day. Plus then we have all the autopilot and software margins that are going to add to it. Tesla can then book that into a lower cost, just keep those margins fixed at 20, 25%, 30%, whatever the case may be, and continue to drive the retail price down and volume up. That has cost benefits from economies of scale. It's just this amazing virtuous cycle as Tesla grows. So yeah, I can't overemphasize those margin points enough. Assuming everybody fully gets that now though, let's look at the other important notes from this point. Let's stick on Model Y for a second. Tesla also says, quote, "We were able to build more Model Y vehicles in its first quarter of production than in the first 2 quarters of Model 3 in 2017. That means greater than 2,685. The following 3 quarters, Tesla built 91,600 Model 3s. That means Tesla was well ahead of that pace before they had to shut down the last 8 to 9 days of the quarter. If this was occurring in a normal macro environment, I would be very confident in Tesla's ability to produce more than 100,000 Model Ys this year. That's something that I've been sort of pounding the table on here for, 2-3 months. So I'm really excited that Tesla has now confirmed production for Model Y for the first quarter. We now have confidence in that benchmark and we can start to form projections off of that once we have the production restart date sort of locked in. So Tesla is still uncertain about that, and that is probably the biggest negative from this report, though obviously it should be relatively short term in nature, thinking about, the next 5 years or so. The margins are much more important than the short term guidance. But Tesla says, quote, "It is difficult to predict how quickly vehicle manufacturing and its global supply chain will return to prior levels. Due to the wide range of potential outcomes, near-term guidance of net income and free cash flow would likely be inaccurate. We will again revisit our 2020 guidance in our Q2 update," end quote. And then specifically on deliveries, they say, quote, "We have the capacity installed to exceed 500,000 vehicle deliveries this year, despite announced production interruptions. For our US factories, it remains uncertain how quickly we and our suppliers will be able to ramp production after resuming operations. We are closely coordinating with each supplier and associated government," end quote. So we talked a lot about whether or not Tesla would reaffirm guidance here, and I think they ended up in this middle ground, which is a good place to be. They didn't remove guidance like many other companies did, instead putting that guidance on hold for now until we have more information about when production can be restarted. What that does tell me though is that we were on the right track with our discussion around how Tesla still had a path to 500,000 plus deliveries this year with that May 4th date. It just looks like that may be slipping a little bit more. Hopefully we'll hear a little bit more about this on the earnings call. A couple other important points in the shareholder letter, and then a couple other things to point out with the financials as well. On those vehicle deliveries, Tesla says that Q1 was, quote, "pacing to be the strongest quarter of deliveries until our operations were interrupted in March," end quote. So we know Tesla delivered about 88,500, but in Q4, Tesla delivered more than 112,000 vehicles. So Tesla here is saying they would have delivered roughly 25,000 more vehicles and set a new delivery record in Q1 on top of expiring tax credits and a seasonally weak Q1. That is incredible. It's almost tough to believe that, but if Tesla had actually achieved that, I bet they would have been able to be inducted into the S&P 500 after this quarter. I think they needed roughly $165 million in net income this quarter to get to net profitable over the last 12 months. And of course, we only saw the 16 million GAAP gross profit. And I haven't done the math, but I think with 25,000 more vehicles delivered in Q1, Tesla would have achieved that. This was already a crazy beat for Tesla, but if Tesla had achieved that, I don't even know. It's crazy, but it shows how well positioned Tesla is when everything starts to normalize again, which is obviously an open question. Looking ahead to Q2, over the last 3 quarters, Tesla has generated GAAP net income of $264 million. So if Tesla can manage to eke out even $1 of GAAP net income in Q2, that means the trailing 12 months will be net positive. That is the requirement for S&P 500 inclusion. And then it is recommended that the most recent quarter also be positive, though from what I've read, there may be some flexibility on that last quarter requirement. We'll have to do a little bit more digging on that, but if that is just a recommendation and not actually a requirement for that last quarter to be profitable, then Tesla could post as much as a $263 million GAAP loss in Q2 and potentially still have eligibility for the S&P 500 after those results come in. This is of course important because a lot of funds track the S&P 500, so a lot of funds would then be acquiring shares of Tesla. Looking at the energy business, Tesla's solar number was a bit disappointing. They were down 35% quarter over quarter, down 26% year over year to 35 megawatts. Storage deployed was also down 51% quarter over quarter to 260 megawatt hours, but up 14% year over year. But Tesla did have positive commentary about their mega pack order book, saying they have reached an inflection point in terms of interest in that product from utility scale projects. And they also threw in a nice note about delivering their 100,000th Powerwall. On the solar roof, Tesla did say they reached production of 1,000 solar roofs in a single week, so nice to see that note, though they had tweeted about it previously. Again, I think we'll hear a little bit more about that on the earnings call. And then on gigafactories, Tesla said their Gigafactory Shanghai ramp is progressing according to plan. and they expect Model 3 will achieve a production rate of about 4,000 per week by mid-2020. That means we could see production for Shanghai for Q2 be maybe somewhere around 45,000 units. On Gigafactory Berlin, Tesla says they have completed their land preparation and are about to break ground, and based on their current progress, they're on track to start Model Y deliveries from Gigafactory Berlin in 2021. Same thing there on Model Y from Gigafactory Shanghai. On the Semi, Tesla said that they expect to move the timeline for that out to 2021. Last thing I want to talk about here is on the regulatory credits. Those came in really high, so I had estimated about 140 million. The street was at about 170 million. Tesla in actuality posted sales of about 354 million in regulatory credits. That's one of the reasons the GAAP margins are so high, and obviously played a big role in Tesla getting to that overall GAAP profitability. Shorts are going to hype that up, but as we talked about, the underlying fundamentals are still incredibly strong this quarter. Still a lot to be happy with there despite the high credit sales. And with the Fiat Chrysler deal, we may actually continue to see regulatory credit sales around this level for the next couple of years. So that'll wrap this episode up. Again, we'll do another episode today after the earnings call. So I'll add that as a little pop-up here on the screen when I have that episode done, and the link will also be in the show notes. Again, congrats to Tesla for a great quarter, and thanks for listening.